Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I trust you all had a restful weekend and have a productive week ahead. Thank you everybody for all the feedback I received on the Saturday video, where I did the first fully filmed video in over 18 months. The feedback for the delivery style was overwhelmingly positive. However, because I do this channel in addition to a full-time job, where I record in my office, I cannot film full episodes from Monday to Friday, at least not currently, while maintaining 6 videos a week. But I will still try to incorporate filmed videos from time to time when possible going forward. Now it is Monday, so today will be a very economy and business heavy video. Over the weekend we learned that Beijing will let local governments raise about 1 trillion yuan, approximately $140 billion through bond sales to repay the debt of local government financing vehicles and other off-balance sheet issuers. Of course, as regular viewers know, local government financing vehicle debt is part of the wider systemic issue of local government fiscal conditions. Local government financing vehicles were traditionally used by cities to raise money for infrastructure projects, but in recent years, as productivity gains from these projects have declined, these financing vehicles have become debt-laden and risky. The International Monetary Fund estimates 66 trillion yuan, $9.1 trillion in total debt is held by local government financing vehicles. Officially, local government debt rose to 92 trillion yuan, or 76% of economic output, in 2022, from 62.2% in 2019. However, some analysts argue that hidden debt makes this much higher. We remember last month Beijing pledged to unveil a basket of measures to tackle local debt risks without giving many more details. Measures will likely include debt swaps, loan rollovers, and even debt issuance by the central government as a form of bailout for some localities. Though, of course, the risk of moral hazard, which is what got local governments to where they are now in the first place, will continue if bailouts are too widespread. And of course, 1 trillion yuan will barely scratch the surface of the problem. It is just 1.5% of the estimated total local government financing vehicle debt, and will likely be allocated to alleviate the most acute debt pressures at the local level. Indeed, over the weekend, UK-based The Financial Times reported, citing an unnamed source, that Beijing has identified so-called high-risk localities, including Guizhou, Hunan, Jilin, and Anhui provinces, as well as the city of Tianjin, about an hour east of Beijing, infamous for its accumulation of debt in recent years. And more support is likely to come too. Quote, "This step will help tackle local debt risks and more measures will be rolled out. Authorities hope to gradually resolve the debt issue with a basket of measures which could take some time." End quote. Next up, Chinese financial media outlet Caixin, according to calculations based on the annual reports of China's largest internet companies, has observed in a report released over the weekend that Chinese technology sector slashed their workforces in 2022, quote, as they grappled with a slowing domestic economy and the aftermath of an industry-wide regulatory clampdown. End quote. 6 out of China's 10 biggest technology firms by market value, writes the outlet, including Alibaba Group Holdings Limited and Tencent Holdings Limited, cut the number of employees by around 4% to 10% last year, a development which, quote, stands in contrast with the hiring spree they went on in 2021, when the firms expanded their headcount by around 22% on average. End quote. According to Caixin's calculations, Tencent, the largest technology company by market value, reduced its workforce by 3.8% in 2022, letting go of 4,300 people. Meituan reduced its workforce by around 8%, Alibaba by 7.7%, cutting approximately 20,000 jobs. As many regular viewers are no doubt thinking, the outlet also observes that the reversal in big tech's hiring trends is putting additional pressure on China's job market, which is currently seeing historically high levels of youth unemployment, with over 1 in 5 young people unable to find work, and that is just according to official numbers. Last month, Premier Li Qiang met with technology company executives, calling on them to promote innovation and create more jobs. Next up, international tourism, and China-focused hedge funds are feeling the pain. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. Liking, sharing and subscribing, 50% of regular viewers are not subscribed, are all huge helps for the channel, and for anyone who can go the extra mile and help keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. It is my hope that one day I can do China Update as my primary job. Thank you so much everybody for the ongoing support. Next up, late last week, the Ministry of Culture and Tourism said in a statement that a ban on group tours to a large set of countries, including the US, UK, Australia, South Korea and Japan, has been lifted, in a sign that what once was the world's biggest source of tourists may be coming back. The immediate lift of the ban excited the markets, with Japanese and Korean tourism stocks surging. For example, Lotte Tour Development Co. rose 29% in Seoul. According to the United Nations World Tourism Organization, Chinese travelers spent $255 billion overseas in 2019, accounting for almost 20% of all international tourism spending. So markets are hoping that there will be some return to this going forward. Experts warn, however, that it will take some time before international tourism numbers return to pre-pandemic levels, especially considering that Chinese consumption remains weak and domestic tourism itself still remains underwhelming compared to pre-COVID numbers. Many Chinese are also acutely aware that the world, especially the developed world in the West and East Asia, now have much more negative views of their country than in the past. Quote, there will be someone going, you'll probably still have someone, but the size of overseas travel won't be as large as you saw before pre-COVID or the pre-economic slowdown. A lot of Chinese people will be hesitant to go to Western countries, worried that they'll face discrimination. They may also simply not have the funds. End quote. Indeed, despite the end of zero COVID, tourism numbers remain very low. According to the China Tourism Academy, in the first half of this year, Chinese tourists made about 40.4 million trips overseas, 26% of pre-pandemic levels. By July, international flight capacity was still only about half of 2019 levels. This disparity has been felt more acutely in some destinations too. According to the Japan National Tourism Organization, in the first half of this year, PRC travelers to Japan only returned to 13% of the pre-pandemic levels. In 2019, this was Japan's biggest tourism market, representing $12 billion. Meanwhile, on Friday, the US Transportation Department announced that flights between the US and China will double from its current levels by the end of October as the two countries relax travel restrictions put in place during the pandemic and kept in place largely due to political difficulties between the two sides. Each country will gain an additional 6 weekly round-trip flights as of September the 1st, up from the current 12. We note, though, that before the pandemic, weekly flights between the two countries averaged 340. And finally, for today's video, over the weekend, US financial media outlet Bloomberg, reporting on recent findings from London-based investment data company Preqin, Preqin Limited, observed that, quote, foreign investors are losing interest in China, and hedge funds that target the country are paying the price, end quote. According to the Preqin findings, the number of active China-focused hedge funds has slipped for the first time in over a decade, with only 5 new funds launched this year as of June. Another 18 funds were liquidated, the data show. Bloomberg writes that the contraction marks a major shift for offshore China hedge funds, which accounted for almost half of new funds in Asia as recently as 2021. Quote, as investors sought to ride the wave of the once high-flying economy and capital markets, end quote. The outlet explains that Beijing's crackdowns on private companies and industries including after-school tutoring and e-commerce, along with growing geopolitical tensions with the US, have led to weak returns since then and, quote, sapped global investors' appetite for China assets, End quote. One portfolio manager at Persistent Asset Partners Limited told the outlet, quote, "We definitely have less demand for China managers from both Asia and foreign investors." End quote. According to Eureka Hedge data, China-focused hedge funds are facing a, quote, "unprecedented second consecutive year of losses." End quote. The above-mentioned Preqin data show that more than two-thirds of China-focused hedge funds lost money in 2022, while 36% were down a fifth or more. In the first half of this year, 62% of China funds made no money. The MSCI China Index has dropped 43% since the end of 2020 versus a 19% gain for the US S&P 500 index over the same period. However, some analysts, albeit a contrarian minority, argue that we may simply be seeing the decoupling and the resulting destabilization of capital market formations, as North American capital, especially from institutional investors like pensions, are pulling out of China due primarily to political risks and other forms of uncertainty, and the result will eventually be two new capital poles. Quote, "We've grown up in a world where it's a US-led global world order. Going forward, it will be a two-sun solar system. One is US-led, one is China-led, and there will be planets that revolve around each one." End quote. Whether this is an accurate characterization, we will find out in the coming years. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Monday, and I will see you all tomorrow.